Welcome to my webcast about the balance sheet. The objective for this webcast is for you to understand the balance sheet, its purpose, know what should be included and what not, and last, to enable you to identify the information presented for further use. Afterwards, I hope you should be able to draw up a simple balance sheet by yourself. Here you see a balance sheet of the Walt Disney Company. They present their assets, and later on you see the liabilities and the equity. So a balance sheet gives and compares the value of all resources, we call assets, and the financial sources used to acquire the assets. So, to say it simple, who paid for it? You can consider this balance sheet as a picture of the company's assets at a particular moment in time, a selfie. The balance sheet is just one of the financial instruments we know. We also know the income statement or profit and loss account and the cash flow statement. To say something about the company's performance, you at least need the first two to assess the company's performance. But if we look at the balance sheet, you probably need more than one. If you have two pictures, you can actually compare what's different. So, in the next minutes, we'll walk through the balance sheet and all its lines to enable you to identify the information you need and how you can use the balance sheet. Here you see a simplified overview of a balance sheet. It's presented in the classical T format, with, on the left side, the debit side, all assets. Assets are the things that you have. On the right side, which we call the credit side, you can actually see who paid for it. This should always be balanced, as in its name. The information is provided from the ledger accounts provided by bookkeeping. It's of high importance, of course, that this process is set up in such a way that it provides the required data timely, accurate and complete. In this webcast, we'll limit ourselves to the basics of the balance sheet. Bookkeeping, accounting policies and depreciation, profit appreciation and more advanced topics are not discussed right now. But as you see, the information is grouped in certain blocks: long-term assets, current assets, equity, long-term liabilities and current liabilities. This is a fixed order, so the information can always be found on the same place. In the next minutes I will discuss all categories in brief, present all the most essential principles and some of the specials you need to understand the balance sheet. Let's start with the long-term assets. These are always presented in the T format at the top left corner. As in language, there are multiple ways to express yourself while saying the same. So long-term is also mentioned as non-current. Long-term is every asset that's used longer than 1 year or production cycle. Assets, which we are discussing, are items controlled by the company. So the items listed are owned and used by the companies. Rented, long-term assets are not included on the balance sheet. So remember, it should be controlled by the company to be listed in the balance sheet. Within this category of non-current assets, we have three categories. Again, they have a fixed order and should be listed in the way discussed. First, we start with intangible assets, then tangible assets, and we end with financial assets. Intangible assets. Intangible assets are things you own because you created or bought them, but you can't touch them, but they have value, so you can sell it. So the results of research and development may be patents or trademarks or goodwill. Goodwill is the amount paid above the value if you buy a business, future profits. Then we continue with something more recognizable maybe. Tangible assets. Tangible means you can touch them. So think of the buildings, the factories, the machines, cars, things you can physically touch and use more than once for your process. We end with financial long-term assets. It's investments in other companies like shares or maybe joint ventures, strategic alliances or parental relations. This category is not short-term assets for an excess of cash. It's strategic assets in a company which you own over a year. So now we have discussed all non-current assets. So we continue with current assets or short-term assets. Assets that are in the business less than a year. For current assets, the order is a bit different. We start with tangible items over the non-tangible items and end with the financials. By now, it's time for you to understand that finance is not always a hard science. There are many assumptions and estimations, and therefore some of the information presented is an opinion. These are made on accounting principles and according methods. There are two things which you need to remember here. One, you should not always change your method without good reason or explanation, and when comparing two companies, make sure they use the same accounting principles. Otherwise, it's like comparing apples and oranges. So the inventory should be specified for each category so the reader understands the value and the position of the company. Products that have a longer production process, like vessels or yachts, have less value than the combination of their used raw materials. However, the finished product has more value than the sum of the materials used. So you need to specify the category so the user understands the value of your company. Another type of short-term receivables After listing your tangible current assets, you continue with the intangible assets, like receivables and claims. So receivable is an asset destination applicable to all debt, unsettled transaction or other monetary obligations owed to a company by debtors or customers. So this is money you still have to receive. For debtors within receivables, the company should always periodically assess the chance of successful collection. Sometimes there's a separation to another category of doubtful debtors. Receivables which you're not certain you will ever receive. We end the current assets with the cash and cash equivalents. We end with them not because they're less important, but because they are the most flexible assets and, if not invested, do not generate a return. For organizations, it's vital to have the right amount to pay all the obligation, but not in excess, as the cash could alternatively generate more returns. We now move to the right side of the balance sheet. On the right side of the balance sheet you find actually who paid for all the assets which we discussed earlier. We start with equity. The equity is always made available for a longer period of time. The equity can grow when the company makes a profit. In the end, the owners determine whether they actually want to receive a share of the annual profit, called dividends, or if they would like to retain the profits, which means that the money stays within the company to generate future profits. The equity is normally determined last. So the equity is the residual item and is the difference between the total assets So that's the non-current assets plus the current assets minus the liabilities. Let's discuss shares first. We know two types of shares. We know common or ordinary shares. We know multiple types of shares. Of course, there are the common shares or the ordinary shares, but we also know shares with particular characteristics. We can call them preferred or priority shares. These shares have certain privileges to the owner with regard to the controlling interest and or the profit shares. As these are not the same as the common shares, they should be listed separately, and most of all, they're listed earlier. The amount shown is always the sum between the number of shares issued and their par value. Par value stands for the value for which they are registered. This value is not relevant for the shareholders, as the par value is not of relevance and probably the shareholder has paid much more. The difference between what the shareholder has paid for the share and the par value is mentioned in the share premium. So the share premium is calculated by the paid price minus the par value. Let's continue on to the reserves. Reserves are also part of the equity. All savings from the company parked for future obligations and profits not paid to the owner are listed in this category. Sometimes the profit before profit distribution is also included under reserves. However, as these could be paid to the owners, some companies list them under liability as the last items. Again, you see, there's choice. Reserves are always made for specific purposes, like warranties, expected expansions, new build of premises, and so on. They are primarily listed separately to give insight to the reason of the relatively high reserves a company obtains. Let's move on to the next category, the liabilities. As you can see, liabilities are also divided into two groups: over a year, long-term or non-current, or shorter than a year, current or short-term. As you see, the division in period is the same on the debit and the credit side. Provisions are a special type of reserves for a liability that's likely to occur, but when and the amount are not certain. Provisions are because of an event in the past on which the outcome is not yet final. You could think of a claim, a legal decision. So, provisions are future obligations based on estimates. Next, the long-term liabilities are listed. These are loans or credit that run over a year. They are listed in the order of preference of repayment. So first, preferred creditors, then creditors with collateral, like a mortgage loan, then the ordinary creditors, and last, the subordinated creditors, which are mostly non-financial institutions, like a family loan. And last, the short-term liabilities are listed. These are all accounts that have to be paid short-term. You can think of suppliers, loans for a short period, taxes, which have to be paid to authorities, or dividend payments to the shareholders. As you can see, we now discussed all the categories in the balance sheet. Thank you for joining me in this webcast on the balance sheet. For comments and or questions, do not hesitate to contact me. I hope to see you again in one of my webcasts. Enjoy!